Good evening, friends. I hope all of you are doing great. So this is your good evening, friends. So this is your chauffeur for some of the topics for financial management, continuing our journey, Chartered Accountant Manobha Verma, and I'm sure you all are keeping good, busy in your schedule and preparing for examinations. I can see a lot of excitement. I can see a lot of people joining in the query session already. And first things first, I'm sure you guys have been preparing for a lot of sessions which are already covered, doing some practice. And the last time we had discussion on a couple of days was with respect to cost of capital, right? So at that time itself, I told you that we will be needing to have that clarity on what is the importance of the cost of capital from sources of finance. That will be its application in investment decisions and working capital management. So between today and Tuesday, we will be focusing on your investment decisions, and that will be our major agenda. Now, when we talk about investment decisions, guys, I hope you understand that yes, once we recollect the three objectives of a financial manager. What were the three objectives? You guys told me last time around as well. We're talking about the financing decisions, investment decisions, and a distribution, right? So when we talk about the investment decisions, I think the most important reason, can anyone tell me why this decision is very important? Why investment decision is very important? What do you think, guys? Why is an investment decision very, very important? So let me see if I can see some response. So I'm repeating my question, guys. Why investment decisions are important decisions for an organization? We also call them as a decision involving capital budgeting, right? I think capital budgeting is a term which kind of gives a little bit of a hint towards what I'm asking. Right. So Hitesh says it tells about the future performance of the companies. Smitha has a point because of funds of stakeholders outside his fund. Okay. Anyone else? Smitha says huge investment is involved. Bandredi says for optimization of for optimum utilization of the funds. Karthik says cost at which you acquired is high, so you have to invest it wisely. And this again, I think these are good points, right? Pooja says good investment or good return. So I think these are good points. But when I connect all these answers, do you agree? Sarup has a very interesting thought that this is where the action points, real action starts. Now, if I connect all of your points and what we have studied is, you remember the objective which related to the wealth maximization, how that was possible, maximize the return and minimize the cost. We decided that, okay, we want to go for that cost of capital, which kind of that capital structure, which gives us a minimum weighted average cost of capital. However, at the same time, it's very important to understand that investment decisions, capital budgeting decisions involve huge amount of funds which carry some cost, right? So these are the funds which definitely carry some cost, which we discussed as a cost of capital. I think one more reason which makes these decisions very crucial is that not only these funds are scarce, you don't have funding in abundance, right? You don't have funding in abundance that you can probably invest every project, right? You cannot. You generally have limited funds available. Second, these are irreversible decisions, guys. If you invest in these any of these projects, will it be that easy to take a U-turn over there? Will it be that easy to take your money out? What do you think, guys? I don't think so, right? So and more so because these decisions by its nature relate to long term. Now, when I say long term, yes, that means the real performance will be evaluated, or the actual results will be spread over the number of years, and that's why the evaluation is very important for us. Decision where to invest the funds are important, and that is why capital budgeting plays its important role here. So what are the steps involved in capital budgeting? First we need to identify basically we talk about the first step as identification. What are the projects I could involve in? And projects, those need to be mapped with my strategy, my objective. Then once we identify the projects, for each of the projects, I need to understand what are the cash flows associated for each of the investment proposals so that we can compare those projects, right? We have to, we will talk about this, how to calculate the post-tax or what is the post-tax cash flows. We'll talk about this. And then based on the, evaluation, we will have to select that particular project which maximizes the return, because see, the idea is wealth maximization. Not only that, once we have selected a particular project, we need to keep a monitoring as well. We need to keep on our control. We need to keep on review the progress. You never know, if you thought that, okay, this project should behave in such a way, but in reality, there might be some factors you did not consider. Now, and of course, these decisions are important because of the factors we already discussed, right? Now, to ensure that we try to be optimum in our approach, there is a process we should follow. And when I talk about this process, guys, these are the steps, or on screen you can see that as part of the planning stage itself, there we are identifying the potential projects or investment avenues. And when it comes to the evaluation, I already told you, evaluation will be with respect to the amount of capital outlay involved and the cash flows that the project will be yielding over the number of years. And based on that, I would be actually doing the selection and implementing the actual project. So these steps are definitely self-explanatory, but very, very important because of the nature of the significance of these capital budgeting process itself. Now, briefly, I would like to talk about, there are a couple of types of capital budgeting decisions, right? We will be discussing these also while we will be evaluating the decision points where we have a choice of multiple projects. Now, one way we can decide on the capital budgeting is basis the firm's existence. Now, what do you mean by basis the firm's existence? Of course, we understand that every entity plans to go for a foreseeable future. We talk about the going concern, right? But what about different projects, right? What about the factors which may not be in our control? Let's say technology. What about the economic life of the asset? So there are certain type of decisions which are on the basis of firm's existence itself, the strategic factors which could turn around the way the firm has been operating. Now, some examples here are like replacement, whether we should, continue with the existing setup or we should go for a replacement. That depends on how long we have been using the existing setup. We talk about the modernization, or let's say based on the demand, should we go for any expansion or not? See, what I'm discussing here is that certain decisions have to be made, right? The question is whether we should go ahead for this or we should not. Evaluation we will talk about. What are the factors? For example, if I talk about expansion, guys, do you agree with me that probably I will need to compare that, okay, how much it takes to invest more to expand? What is the additional outlay involved and what are the additional benefits? So we will be comparing those additional benefits and the additional capital outlay so that we can decide. Similarly, basis the diversification. This is, some projects which are like, or rather some avenues which the firm's existence comes into the picture. But there could be also a situation, guys, basis the alternatives in front of us. When I say alternatives in front of us, I am talking about the decision situations faced by the organization. Let's say we talk about mutually exclusive decisions. Acceptance of one proposal will exclude the acceptance of other. How is that possible? I've already answered that. Can anyone tell me why or how? Can there be a situation where acceptance of one proposal will automatically exclude the acceptance of other? Can anyone tell me why would that be possible or why would that happen? We just discussed that on the last slide. So let's see if you can correlate, guys. Again, repeating my question, how could this happen where we end up accepting a project and the other one is automatically rejected? Swaroop says, in terms of the limited resources, okay, good point. So I think that's spot on actually, Swaroop. We're talking about, we don't have unlimited funds, right? Swaroop also talk about irreversible. So I think I would go with your first answer that we have limited funds, right? So if we invest either in project or project B, so if our funds are exhausted, how can we select the other project, right? Am I correct? Or probably I can think of another example. Let's say Siddhant also says the same, that funds are limited. Or we can say that, okay, there is a sourcing of raw material, and we have enough resources, not only in terms of funds, we have only enough resources or enough raw material to put in only one project, right? So inputs, that could also relate to funding only, right? Now, certain types of these projects are actually called mutually exclusive decisions, where one acceptance will mean rejection of others. So, for example, if as a company, I plan to go for additional line of product, and I have two choices. I'm not my decision factor itself is just to expand one line of product. I'm not going to expand into multiple lines. That means if I select any one, others are rejected. That's my policy. Similarly, we have certain type of decisions faced with us, like accept or reject. What about the acceptance of additional orders? We have to see that, okay, are we operating under capacity or not, or can we see the benefit out of it? What was the revenue anticipated? What is the cost involved? All those factors will be considered. And then another type of decisions are contingent. Now, which could be again requiring some additional funding, wherein we have to see our financing aspects. Do we have enough funds, or can we involve or invest in multiple projects at one point of time? We will talk about that when we will be doing some kind of a practice, that can we involve or invest our funds available into more than one project. Factors like whether the projects could be divisible. So those are the things we'll be talking about, guys. So just giving you a broad perspective that you could be, as a finance manager, faced with various decision-making scenarios wherein you have to decide a capital budgeting here, right? So first of all, we start with understanding the project cash flows here. Do you guys realize that since it is a long term, these projects relate to the longer term, it's very important that, and because the factors are these are irreversible, limited funds, it is very important that we do as much as calculation today itself. Do you agree with me, guys? So we need to make available of best information available to us. Ensure that we can estimate, we can predict the future cash flows. We can predict what will be the benefits from so and so project. What is the initial cost? And then because we have to take a decision, we cannot just simply add the future cash flows as is, right? There are different points of time. We might have to understand something called time value of money. We have to bring everything in future as of today's date, and we have to accordingly do our calculations, guys. Right? So for most of the capital budgeting decisions, guys, very important that we need to understand our basics, especially it relates to the project cash flows. Now, we need to first focus on, okay, only incremental cash flows are considered. What is incremental? Like cash flows which change as a result of a decision, right? So that's very important. And we know that, yes, timing doesn't match. So the cash flows may come up in the later years, and we are talking about initial investment, right? Hiral has a question. Hiral says, why we perform capital budgeting? What is the motto behind that? Wow. Hiral, again, I think when we started the lecture, we discussed about the objectives of a finance manager. We talk about the financing, investing. So for running into different projects, you would be needing funds, which you would have arranged for, as we discussed earlier, in sources of finance and cost of capital. And you may have multiple projects wherein you could invest. That is why it is important we need to evaluate. We need to select appropriate project where we can actually invest those funds. We generally don't have unlimited funds. Hiral, I hope that makes sense. Definitely capital budgeting is required. That's what we started our first couple of slides into. Yeah. So here we are talking about, we will be considering the initial or other incremental cash flows, specifically when we are saying that, yes, my initial stage may involve a lot of cash outflow, but inflows may be coming in the later on years. Now, there are certain factors that we need to consider while we are talking about incremental cash flows. Mind you, in capital budgeting, my focus has been on cash flows. My That means what I'm trying to say is that I might not be considering the non-cash related expenses. Why is that? Because we are talking about utilization of funds, right? So first factor here, guys, depreciation. Now, what are we talking about here? If I invest in a particular project that may involve some kind of investment in machinery, we generally record the depreciation on that, right? So depreciation is non-cash, but can we say that depreciation can result in or can have some kind of a cash impact? Yes, it is. As per the Income Tax Act, we need to understand that yes, depreciation is an allowable tax expense, and it is actually calculated using the block of assets concept. So what we need to consider is the tax shield. Tax shield means savings in tax. Because of depreciation, my taxable income will be reduced, and hence the tax outflow will be reduced. So we need to consider the tax shield of depreciation. Mind you, we will be following the income tax rules, as in like block of assets, wherein we do not record gain or loss until and unless there is even a one asset in the block left. Now, another factor we need to consider is opportunity cost. Can anyone give me an example of opportunity cost here? When we say any foregone benefit to be taken into account, can anyone tell me how come opportunity cost come into picture here? Any example, guys? What do you think? Mind you, we are talking about incremental cash flow, so keep that in mind, right? Keep that in mind. So in the incremental cash flows, we might have like initial outflow. So we may have an initial outflow, and then we have yearly inflows or cost savings. So those are incremental cash flows. But apart from that, apart from these two major headings, we are looking at these factors to be considered, right? Or not to be considered. So people are saying shares with differential voting rights. Pooja, what is shares with differential voting rights have to do here? I don't think so. Shares with differential voting rights are not that relevant in terms of the opportunity cost. Hero says labor work cost. Smita says interest on deposit. Smita, I like your answer. What about others, guys? Anyone else want to answer this? I can repeat my question. Can anyone think of an opportunity cost associated with any project? 10 years ago, land acquisition. Wow. Gomathi, that is a sunk cost, right? So not even to worry. But I can probably add on one of your answers, guys. Gehani says retain earnings. Guys, imagine that when you want to enter into a project, you have to vacate or probably one portion of your factory which was given on rent. When you want to enter into a project, you need some space, and there was a section of the factory which was given on rent. You have to get that section vacated and run your project there. Do you agree that in that case, that rent you will be losing will become an opportunity cost? Do you agree that means? Because for a particular project, you would have been losing on that rent, you would be otherwise anyways earning. Guys, everyone with me on that? I'm just giving an example of opportunity cost. Yeah. Now, the other factor is sunk cost, guys. Now, for example, Gomati said 10 years ago, land acquisition. Some costs which I've already incurred in the past. If I've acquired any asset, let's say existing machinery is there lying unused, you want to use in the project. So there is no cost attached to that, right? Historical cost which is already incurred is not incremental. That's a sunk cost. We'll not consider that. So we say that, okay, the sunk costs do not impact. Now, very, very interesting point, guys. Next one, working capital. Now, when we talk about working capital, there could be three types of discussion in working capital. Let me give you a little bit overview on this one. When I'm saying working capital in terms of the capital budgeting, there could be a scenario A where a particular project requires increase in working capital in, let's say, beginning of the project in year 0. And once the project gets over, let's say year 5, the working capital may not be required. So at the end of the year 5, you can withdraw that working capital. Is it a very realistic example, guys? I guess so. You're doing a particular project and you need some additional working capital, that's okay. So you increase the working capital in the beginning of the project, but you withdraw that additional working capital at the end of the project. That could be one scenario. Another scenario is, let's say this project related to IT or any kind of a cost saving project. There is an IT project which results in cost saving. And because of this, let's say you want to just run this project for 3 to 5 years, you actually have a reduction in working capital initially. And once that experiment is over, let's say after 3 years, you may, if you stop that project, if you discontinue the project, your working capital may have to be increased. So it depends on what's happening in the initial year. What's happening in the initial year. Another possibility is, let's say that with any project you incur, let's say you require some working capital, right? So let's say this is your working capital level. Now, this project is such where after every 2 years, you need some additional working capital. Are you getting me? So basically, let's say if it's a 5-year project and there is some additional working capital required after second and after 4th year. So that means there is a bump up of the working capital. And of course, once the project is over after 5 years, depending on the requirement, the working capital can come down. What I'm trying to make you guys understand is working capital analysis could be important. You have to be careful basis the information given in the question. That means working capital generally will have two impacts. Generally, I'm saying one is at initial stage and at the end. And third, definitely it could be incremental during the tenure also. Guys, I hope everyone is okay with the working capital stuff. This will be important for most of our questions. Now, someone asked me, give an example on opportunity cost. Guys, I already gave an example of opportunity cost, right? We talk about let's say you have to vacate a rented portion. If you have to vacate a rented portion, your rent lost will be opportunity cost. This is what I explained. Yes, everyone okay with that? Now, moving on to the next part. Next part says allocated overheads. Now, allocated overhead is what? Let's say at a corporate level, some overheads are incurred. And those are allocated to different projects. Do you really think that these should be considered allocated overheads? I doubt. However, if there is an additional overhead that is incurred because of that project, only that part will be incurred. If there is no incremental overhead, only the present overheads are being allocated, which are already there, then definitely you don't need to consider it. Here has a question. Add working capital is outflow of cash and less is okay. So here it's like if you have to invest more working capital, that means probably you have to purchase the stock. You have to allow some credit period to debtors, right? What is working capital? Current assets minus current liability. So if the working capital is increasing, that means it's an outflow for you, right? Is everyone with me on this? We will be talking about inflows and outflow, by the way. Don't worry. So if working capital is increasing, it's an outflow. If working capital is reducing, it's an inflow. Here, does that make sense? Okay. Now, as I said, any project could either bring in the yearly operational savings or could bring in additional profit. What we need to understand is everything has to be considered net of tax. Because tax is a cash outflow, guys. Tax is a cash outflow, right? So if the project is bringing in savings, cost savings, that will be increasing their profit. Hence, tax will be increased. So whatever it is, it has to be net of tax. Now then, there could be an exception where a project may require an initial outflow and then probably additional outflow later on. If that is the case, you have to consider that as well. I would say on this particular slide, 2 points which are very important. One is a working capital understanding, opportunity cost, and another point which is mentioned at the end, guys, financing cost. Yes, we will be excluding the financing cost. Just like, for example, interest on loan. Why? You may argue with me that interest is a cash outflow. Why are we excluding that? Because when we will be talking about future cash flows here, when we are talking about future cash flows, do you agree to take a decision today where we stand? We have to discount these cash flows to today's value. We will talk about that gradually. Do we agree? If I have to take a decision today, I have to discount these cash flows. For discounting, what need to be taken here? Interest percentage, guys. Am I correct, everyone? Can you please confirm your understanding? If we are discounting these future cash flows to today's present value by using that interest factor, in that case, if we also consider interest in the outflow, it will be double counting of interest, right? So that is why the interest and dividends are excluded, because interest is anyways reflected in the discounting factor. So if they have given you a projected income statement for the next 5 years, let's say, and they're giving you the profit after tax, which also has interest component, you add the interest back, guys. You add the interest back, right? Or probably you can take EBIT and reduce the tax from there. Two options. Okay, question from Hiral. Hiral says allocated overhead. Hiral, I already explained. Okay, so I hope everyone can hear me out, right? So here we talk about allocated overhead, that let's say some expenses are incurred at corporate level, right? If those are allocated, whether or not you are doing that project, it doesn't matter, right? Just because you entered into a project and some overheads are allocated to you also, that doesn't mean that you should be considering them because they were already being incurred. But if there's some additional overheads because of that project, then you should include that incremental. Prabhas has a question. One doubt, opportunity cost to be deducted before tax or after tax? My view is that before tax, as we're calculating economic profit. Okay. So Prabhas, again, the point is, if I'm reducing I'm foregoing the rent, what do you think? When the rent was there, anyways, it was net of tax, it was a less amount, right? So if you were earning about 100,000 from a rent, like 1 lakh, probably after tax, you would be earning 70,000, right? So why would I add 1 lakh? I would be adding 70,000 only, the amount I was earning eventually. And that would have been after tax. So Prabhas, we are actually including the opportunity cost in real sense, the cost of benefit foregone, not in the sense of only economic profits. You would have been earning rent, and if you have been earning rent, you would have paid taxes on that, right? Okay. Okay. So the question from overhead was actually not from Hiral, but from Smitha, I guess. Smitha, I think you got that point. Smitha, I hope you got that point. And there is another question coming in from financing cost. Okay, financing cost we will be discussing in the later slides, guys. We have some questions we'll be talking about financing cost. Don't worry about that. What I'm just explaining at this point is, guys, everyone understand that we have EBIT, we have interest, which tells us profit before tax, and we have tax then, and we are given. So let's say the question gives you profit after tax information. Make sure that we add back interest in that if interest is already reduced, because we will not consider interest while calculating the cash flows, because we'll be discounting them. Guys, everyone till now, okay? Don't worry about the actual application. This is just a beginning. I'm just introducing you to some factors that we'll be considering. Don't even worry about the practical calculation. We will be doing a lot of practice, guys, between today and Tuesday. So don't worry, okay? So now we are starting to identify the cash flows. And for identifying the cash flows, we are looking at some stages, guys. There are 3 stages how the cash flows are being split. One is initial stage. One is the stage during the project called as interim cash flows. And the third stage is terminal cash flows. Now, what is terminal? End of the project, right? So let's go one by one. What are the initial cash flows? For any project, you would be either, investing some money, like cost of new machinery, including its installation and all, right? So that's my initial investment. As far as the working capital is concerned, I hope you guys understand working capital could increase or decrease. Could be inflow or outflow depending on the project requirement. Not only that, generally, let's say in a decision like where you're replacing a machinery, there could be also a sale proceeds of old asset. in case any tax implication is there, you need to consider that also following the block of assets. So if you're selling the old asset to start a new project, the sale proceeds of the old asset will also become relevant. Mind you, we are talking about relevant, right? When we say incremental, we are talking about relevant cash flows. So these are initial cash flows, initial stage, let's say year 0, today, or maybe first week, right? What are interim cash flows? Once the project is started, so we say, okay, during the tenure of project. So once the project is started, you would expect that project to yield something, right? Some either some profits or reduction in cost. In that case, we will be using profit after tax. Of course, interest will be also not considered, and any non-cash expenses will be added. Let's say like depreciation and all, only tax will be considered. Now, in the case of a replacement though, it could be incremental revenue or savings in expenses, as I said. Any additional working capital, guys. Do you remember the third possibility? I talk about working capital. We can talk about 3 different possibilities. Third possibility for working capital is additional working capital may be required after 4 years or 2 years. Now, terminal year cash flows, it means final year. Guys, when we talk about terminal year cash flows, do you agree that last year also is an year, right? So there will be interim cash flows for the last year also. Anyways, that means your profit after tax and on, right? Terminal year cash flows will anyways include the normal profit after tax. That is for sure. But apart from that, 2 things we need to consider. One is the release of working capital, or if it was a saving earlier on, we will say reinstatement. So let me give you a table for the working capital. This is initial. This is end of the project. If at initial stage, there was an inflow as in saving, there could be a possibility that at the end of the project, it may require a reinstatement. That means or rather restoring the working capital to the earlier levels. And most of the times, there is an outflow or an introduction of additional working capital. Later on, at the end of the project, there will be an inflow. That is withdraw. You can withdraw the additional working capital because the project is over now. Everyone okay, guys, till this point? Can you guys please confirm if the stages of cash flow is clear to all of you? Please tell me. Or if you have any doubts. One more cash flow in the terminal year is when the project is over, you may be selling the asset, right? So definitely there is salvage value. And if at all there is any taxable gain or loss, the tax impact as well. Right? So I'm getting some confirmations here. Great. So I've got few confirmations from Siddharth, Hitesh, Hiral, Bandredi, everyone saying that all going good till now. So that's absolutely perfect. Now look at this. This is a kind of a suggestive way of how we are talking about cash inflows after tax. So we are just focusing on the cash inflows after tax here. So we are starting with the sales here. We're talking about the sales, how the sales are calculated. Selling price into number of units. Less variable cost gives you the contribution here. Sales minus variable cost. Now, if we reduce the fixed cost, which also have, let's say, something like non-cash, which is depreciation, but you know that this is tax deductible, and hence we are reducing this initially to calculate the tax portion here, and then later on the depreciation gets added. Guys, can you see this? We are initially reducing the depreciation and later on adding it. I hope everyone is okay. Why we are doing this? Because it is non-cash. However, there are 2 ways to calculate the depreciation tax sheet. I can share both the ways with you guys. I'm focusing on the left-hand side right now, method 1. As per method one, earnings before tax and depreciation is 50,000. We have assumed depreciation of 20, and my profit before tax is 30,000. And if my tax rate is 30%, I'm looking at a profit after tax. So I think this is just like my usual income statement. So my usual profit after tax is 21. And what we are doing is, what is the depreciation we originally reduced? We are adding it back. So we got 41. We got 41. That means you calculate your profit after tax as you do generally, just add back the depreciation after it. So that's method one. But there is another method, method two, where we can straight away reduce the entire tax amount from the earning before tax and depreciation. That gives us cash profits. Look at this term, guys. That gives us cash profits of 35,000. However, then someone told you that, okay, well, depreciation is actually eligible for tax saving, right? Depreciation is a tax deductible expense. So if we would have recorded depreciation, there would be a tax saving. So separately on the 20,000 depreciation, we are calculating the tax saving at 30%. That 6,000 is added to arrive at 41. So you can very well see the number you will get the same, but the approach is different in the two scenarios. In the method two, we are just calculating the cash profits and separately adding up the tax shield of the depreciation. In method one, we are not doing anything heroistic. We're just calculating profit after tax and we're just adding the depreciation back. May I get an idea about how many of you are like, you can give your own perspectives. You guys would prefer method one or method two? I don't have any problem, guys. Whichever method makes you comfortable. How you want to calculate depreciation tax shield, I leave it up to you. If you're comfortable with the first method, I'm okay. If you think no, second method is more smart, kind of saving some time, I'm okay. So what do you think, guys? Like, I just want to have a general idea. How many of you are thinking, okay, which of the methods you feel that, okay, it could be good? Okay, I'm already getting some responses like Smita saying method two, Siddharth saying method one, which is like unity and diversity, definitely. I can see those responses coming in from different students. Even Hitesh says method two, but Hiral says method one is the best. You know, Hitesh has a, or rather, not Hitesh, Hiral says method one is the best, but he also says that old is gold. So Hiral says that old is gold. Great. Guys, don't you agree with me that whether you follow method one or method two, the impact should be same? Whatever you do, you have to just clear in your approach, right? Make sure that you do not do a mistake in application. That's what I don't want, right? So do your practice. Bandretti says we are used to method one. That's what I do not want you to change anything, whatever makes you comfortable, right? Now, guys, after all this discussion, we need to understand what are the various ways to actually conduct capital budgeting. We know that wealth maximization is my objective, but we also know the consequences of a bad decision making. There is no U-turn. A hurried decision can lead up to huge losses, right? You cannot be entering into a situation where after you started a project, 2 years into the project, you realize, oh, that's not a good decision. So can we have some wise capital budgeting techniques here to be discussed? You could see that the capital budgeting techniques are divided into two subcategories. One is traditional or non-discounting techniques, and one is a discounted cash flow techniques or time-adjusted techniques. Guys, just from a layman perspective, what do you think? Which is more rational, non-discounting or discounting techniques, guys? What do you think? Which is more rational here? Can anyone tell me? What do you think from a rational perspective? Okay, Gayatri had a very, very interesting perspective that for depreciation, I would use method one, but I would also just cross-check by method two. That's a good perspective. Okay, so I think, again, there are different responses for my question. So Roop says discounting, Smita says discounting, but Pooja says traditional. I think I would tend to agree, guys. To be rational, as I said, we are standing here, right? and the projects could be long term, right? So there could be cash flows in all these 5, 7, 10 years. And if you have to take a decision today, I would probably go for something which can bring everything to the same platform. And the only way I can bring these to same platform is by discounting these cash flows, right? So I would also go by discounting, right? Prabhas, absolutely. This is, I think you exactly said the same, right? That with time there is a cost, right? If I simply ask you, guys, I owe you, let's say 10,000 rupees. Would you like to get those 10,000 rupees today or after 2 years? No, I don't literally owe you, but I'm just going to take an example. Would you like to take those 10,000 rupees today or 2 years later? Keeping aside any emotional factors. What do you think, guys? Everyone would say today, right? Earlier the better. Earlier the better. Why is that? Because you feel that, okay, 10,000 today is much bigger than 10,000 2 years later. Right? So I think you got the answer, right? So I would say, but still, from an examination perspective, guys, and sometimes, not only from examination, sometimes, let's say you don't have enough information available in terms of the projections, in terms of the forecasting. Absolutely, Pooja said the same thing right now, right? So for example, if you don't have enough information or accurate information, you may have to take a call on non-discounting as well. So we will discuss both by then, right? So within non-discounting, we'll be focusing on only two methods. One is payback period and one is accounting rate of return. Okay, these are the two methods we'll be talking about. So let's start with the payback period. Now, as the name suggests, payback. The term is payback. I'm investing something. When will you be able to pay back me? So it's the length of the time that is required for the cumulative total net cash flows from the investment to equal the total initial cash outlays, guys. Does this make sense? Cumulative means in totality, today's, tomorrow's, day after tomorrow's, or next year, after 2 years. We just add back all the net cash flows from the investment and in what time that can return my initial outflow. Mind you, this is not a discounting technique. This is just a payback period. So what you just need to calculate a payback period is initial capital investment and your annual after-tax cash flows, nothing else. You need that just two inputs. Now, how do we calculate this? Of course, it depends on a couple of types of cash flows which are required. But one more thing I would like to add back here is there is something called reciprocal of payback period, guys, which I will be discussing later on, where we say that, okay, if I calculate a payback period as 4, guys, 4. So 4 is like in 4 years, I will be getting my capital back, initial investment back. So in that case, reciprocal of payback period will be 1/4. So reciprocal payback period is generally gives us a close approximation, maybe not the same, but that could give you a close approximation of a project's IRR. I will tell you this later on, that IRR, internal rate of return, is that rate at which your discounted inflows are equal to discounted outflows. So don't worry about IRR right now. Okay, let's come back to the payback period. Now, as I said, in payback period, we have two approaches. In case we have uniform cash flows means same cash flows every year, guys. Uniform, same every year. So let's say a particular project has 5 lakhs as an initial investment. And every year it will be returning, let's say, 60,000. So how much is the payback period? You can just divide that initial investment divided by the annual after cash flows. So the payback period seems to be 8.3. You guys agree on this? So another example, a project costs 10 lakhs and yields annually a profit of 3 lakhs after depreciation of 20%, but before tax. Now here, we need to understand that, yes, which method we need to adopt for depreciation tax shield. If you adopt method 1, we say that, okay, 3 lakhs minus depreciation. 3 lakhs minus depreciation. What do you think, guys? They're given a 3 lakhs after depreciation. So would you do a minus depreciation or not? No, not needed, right? So 3 lakh profit is given after depreciation. So no need to deduct the depreciation. So 3 lakhs net of tax is 1,50,000 and you add back the depreciation. So you get 350. You get 350 here. So in this case, actually, method one is straightforward, right? Because they're giving you the profit after depreciation. So method one is very easy to apply. So method one is very easy to apply in this example. So 3 lakhs minus tax is 1,50,000 and you add back the tax. That's it. Prabhat says IRR and NPV. Yes, Prabhat, we will talk about that though. Prabhat says that, okay, the basic heart of the chapter is IRR and NPV. Good way to look at that. So we will talk about that in the discounting technique. So guys, is everyone clear on the payback period when it comes to the uniform cash flows? Take the initial investment, divide it by the annual cash flows. That's it. Annual after tax cash flows. So in this case, the annual after tax cash flows is 3,50,000. So we get like 10 lakhs divided by 3,50,000, we get 2.86 years. Everyone okay, guys, on this example? I hope no doubts. Now the problem could be that more or less for all practical purposes, very unlikely that projects may give uniform cash flows. Very unlikely. The chances are that projects may have uneven cash flows. Probably some of the projects may have lesser cash flows in the initial years and then probably the real savings come in. So let's take an example of uneven cash flows. In this case, what is important is that once you get an uneven cash flows, you have to calculate cumulative cumulative after tax cash flows, I would say. So we have to calculate the cumulative after tax cash flows. How do we calculate this? So let's take an example here. A project costs 2 lakhs and they've given the after tax cash flows for all the 4 years, 1 lakh, 80,000, 60,000, 40,000. So what we're doing is we're just calculating the cumulative. And once I'm calculating the cumulative, you can see round about third year, I'm getting my capital back. What do you think, guys? Is it happening in the third year or not? First year, you're getting 1 lakh. Second year, you're getting 80,000. So that means till second year end, you're getting 1,80,000. Now, if I am standing at the year 2 end, how much is left? 2 lakhs is my initial investment. 1,80,000 is already in. So we are left with only 20,000 to be recovered, guys. Only 20,000 to be recovered. That means if I look at year 3, the after tax cash flows is 60,000 and I had only 20,000 to recover. That means 20 upon 60. So probably 1/3 of that year was just required to recover. So that means 2.33 years is the answer. So guys, all okay with respect to this? As in, like, it's simple, right? The only thing is we are just doing a cumulative. We cannot just apply a shortcut here, just divide the initial out, divide by the uniform cash flows. There is nothing called uniform cash flows here, unfortunately. So advantage and disadvantage, I guess, back to our school days, right? I know many of you, I'm sure many of you in your schooling days, right, used to write your advantages or disadvantages. Easy to understand, simple to calculate, right? Disadvantage, probably opposite side, right? But yes, definitely it is easy to understand. It is simple to calculate. But the problem, big problem in the payback period is, we know, or rather I would say two problems. One is that it is ignoring the time value of money. It is even considering the cash flows in the subsequent years as a common parlance as today, which is not correct. Second, do you think we are just focusing on how much time it takes to return the capital? Are we actually worrying about the performance of the project after the payback period? That means what is happening after the payback period? Are we talking about ignoring the profitability of the project? Definitely we are. Let me give you an example. We have project A, project B. And when I say payback, let's say project A has a payback period of 3 years and project B has a 3.5 years. Guys, which project will you select? Project A has a payback period of 3 years and project B has a payback period of 3.5. Which project you will select, guys? That's a question to everyone. 3.5 years. Let me see the responses. I think unanimously everyone said project A. Everyone with me on this? Project A, lesser number of years. But what if in reality, project A had many more years to be profitable? Year 4, year 5, year 6, year 7. And let's say project B just had a couple of years after that. Probably so. So the point here is, we are saying, okay, project B having many more years, project A having only a couple of years, you are ignoring the project which may be more profitable after the payback period. That's what I'm trying to say, guys. So if project B has larger number of profitability in the later on years, we're ignoring that. That could be another drawback, isn't it? But having said that, someone who is using the payback period is anyways concerned about the risk, concerned about its capital. So that's okay. Even if it is a drawback, someone who is concerned about, okay, by when I will be getting my capital back, I'm more concerned about that there is no harm in that. But we need to understand that, yes, there is a drawback. So two major drawbacks. We are talking about ignoring the time value and the profitability beyond the payback term. The second non-discounting technique, which talks about of accounting or average rate of return. Now, this is something strangely not based on the cash flows, but rather based on the average annual net income upon investment. What is this average annual net income? Probably we are talking about some like income over the number of years, and we are averaging it out, guys. The numerator says average annual net income and denominator is investment. Right? So the numerator is basically we need to just calculate the average of the income over the life of the project. However, investment could be looked at different ways. One could be your initial investment. One could be average investment. Let's say beginning plus ending divided by 2. One thing is, okay, Pooja has a question. How can we exactly predict the unexpected increase in time? Pooja, of course, future is uncertain, but yes, for your purposes, you will have the information, right? You don't have to take any assumption at your end. So the question will be giving you the factors you need to consider, okay? So I think one particular point you guys need to be careful about is this one. If additional working capital is needed during the project, then your average investment may change. We are look at this formula. The average investment is like beginning plus ending upon 2, right? We are anyways dividing that by 2 so that we need to know that, okay, probably in the beginning, the investment would be else, and probably at the end of the project, investment will be something else. And we take the average. But in the case of working capital, let's see what we are doing. We're saying that, okay, half of the initial investment minus salvage value, we are adding back the salvage value and additional working capital. Why we are doing that? Can anyone tell me? Can anyone tell me why we are reducing the salvage value and then adding back the salvage value? What do you think, guys? Can anyone tell me the logic why we are reducing the salvage value and then we are adding it? Anyone? So let me see the responses of the students. Why we do that? Okay, Prabhas says because salvage value would not form part of the investment and its returns. Prabhas, that's a very, very good attempt. But can I add one thing to your point? So Prabhas, I think you are absolutely right that salvage value is not part of the investment. But why we are reducing it? Probably because the salvage value is an inflow for you at the end of the project. Am I correct? So at time 0, you put in some money. At end of the 5 years, you're getting something back. So you are netting them off and averaging it. However, we are then adding it back because we are adding it back because you will be getting it towards the end. So basically, just for averaging, we are reducing the salvage value, guys. Just for averaging. Salvage value is nothing like rather no role to play because that is not received during the project. It's at the end of the project. Hitesh says salvage value is also non-cash. Hitesh, I would assume that yes, salvage value you may be receiving in cash, right? Okay. Then there are responses from Smita. We add at last installment of the project. Absolutely. So Smita, you are also saying the same thing, right? You're getting the salvage value at the end, and that's why we are just for averaging we are netting it off, but we are actually adding it back. So Gadi Cherla says reduced for calculation of depreciation and adding at the end of scrap value. So I think so Srinivas, I think what you need to understand is depreciation could be a different adjustment here. Depreciation could be a different adjustment, but what we're talking about is scrap value, salvage value. What I mean to say is, guys, please listen to me. If we are talking about the investment, that's a denominator. So some money would be, let's say initial outflow would be here, guys. And then there will be salvage. So if I have to take the average, I will take the average of the two because overall the salvage will be an inflow. I'm taking that average, but because the salvage will be at the end of the project, as Smita also said, we will have to add it back. So just for averaging, we are reducing, then we are adding it back. And of course, there is any additional working capital, then also we will be including that in our investment. Okay. So guys, look at this example. Cisco Limited is going to invest in a project with a sum of 3 lakhs, having a lifespan of 3 years. Salvage value of machine is 90,000. Profit before depreciation every year is 1,50,000. And tax is given 30%. Now, let me tell you, here there is no concern of cash flows, guys. So don't start calculating after-tax cash flows for accounting rate of return. That's what not is needed. So you have to just calculate the annual net income. So what is my annual net income here? So we have 3 lakhs and that is what given to us. That is before depreciation. But there is a tax also 30%, guys. Or 1,50,000 before depreciation, but the depreciation will be charged on 3 lakh to put it other way around. So what would be the depreciation every year, guys? Can anyone tell me what would be the depreciation every year? So 3 lakhs is an investment minus the salvage value, which is 90,000. So 2 lakh 10 divided by 3, 70,000 of depreciation, guys. So 1,50,000 minus depreciation is my profit before tax, 80. And then 30% is tax rate. So 56,000 is my profit here. After tax, 56,000. So that means my every year profit will be 56,000, guys. And let's say if we just calculate that divided by 3 lakhs initial investment, my ARR will be 18.67. However, if I want to calculate the ARR using the scrap value method or average method, remember we talked about of this particular point in the third bullet section, that either you can take initial investment entirely or you could take average investment over useful life. So if you're taking initial investment, we are getting 18.67% as ARR. But if you're taking average, then in that case, we apply the same formula. 3 lakhs minus 90. So we are talking about averaging that 210 and then we are adding it back. So we are getting 1,95,000, which gives us the ARR of 28.72. So we are talking about choice of calculating the denominator. So we are talking about different aspects. One was initial investment giving us 18.67. Another option was calculating the average investment. And another option is we calculate the average of ARR for 3 years. So we get 56. Look at this. My investment is keeping on changing, right? After depreciation, 3 lakhs, 2,30,000, 1,60,000. So my ARR keeps on changing accordingly, and I get an average of the 3, which gives us 26%. Now, I'm sure some of you would be wondering that this doesn't make sense, or rather, this is not as per the norms of time value of money. Not only that, it is not even based on cash flows. Am I correct? ARR itself is based on the net income and investment. But what about the net income, guys? Net income is taken on the basis of the income statement, P&L, financial statements. Don't you think that net income can be varied based on the different accounting policies? Net income may not be a good idea to take. It's based on the estimates. It can be adjusted. It can be manipulated. Not only that, it ignores the time value of money. So there are 2, 3 things here. We are basing it on net income. We are not basing in the cash flows. We are not considering the time value of money. That's the problem. And of course, advantage is that your data is readily available. You don't need to calculate cash flows. That's fine, right? And it covers the entire life of the project. That's the advantage. Question from Smitha. Smitha says, in net income, we did not add back the depreciation to 56,000. Okay. Smitha, the answer to that is we are not using the cash flows. No? We're using the net income. Smitha, got it? Average net income. We are not using cash flows. That's what is my drawback also. We are just talking about the net income. It's not cash flow. Smita, I hope that makes sense. It's average annual net income, not the cash flows. Yeah. But I guess you guys all agree with me that this definitely have these disadvantages. Of course, time value of money we know. And then net income is based on the financial statements, which could be based on estimates and all. So rather than cash flows, it's not a good idea, right? And that's what Smita also wondered, right? It's definitely not a good idea. So what we need to focus on rather is discounting techniques days. What we need to focus is the discounting technique. So question from Hiral. So Hiral, in terms of the ARR, I would not say methods, I would say different techniques to calculate investment is there, and that's why we are looking at various alternatives. So yeah, if at all there is a question on ARR and they are not specifying you which method of calculating the investment, I would suggest you can give a couple of options over there, right? If you take the initial investment, this is your ARR. If you take the average investment, this will be your ARR. Okay, a question from Siddharth. Siddharth, yes, I clarified that. Siddharth says, this method is not giving the actual cash inflow outflow. Absolutely not. That this is based on the net income. And that's what I'm saying now. It's a drawback. Okay, guys. I hope everyone sorted out. Can we start discussing the discounting techniques? That means that's where you waited for. Right? So discounting techniques, it considers finally time value of money. It considers that today's 100 rupees is not same as 100 rupees a year later. We need to understand that if we have to take a decision today, we have to discount the cash flows to their present value using a discount rate. And what discount rate you will be taking, guys? Who other than your group know that better? Being finance managers, you calculated WACC, right? So they will be giving you like WACC, they will be giving you a hurdle rate, they will be giving you the cost of capital. So all these terms could be used. So these are the rates that will be used to discount the cash flows, guys. The first technique here, which talks about of discounting techniques, is your NPV method. NPV. Now, as the name suggests, what is net present value? Focus on the term called net. We know that there is an initial investment. We know the project will be yielding some future cash flows. The net means we'll be taking the difference of the two. So net present value is present value of, again, net cash inflows, because in the later years there could be some outflows. So present value of the net cash inflows and present value of cash outflows or initial net investment. The difference between the two is giving us net present value. And guys, how do we discount? Is everyone clear on this? So let's say these are the 4 years. I will be discounting, multiplying this 1 plus r to the power 1. I will be discounting the second year by multiplying by 1 plus r square. Similarly, the fourth year will be multiplied by 1 plus r to the power 4. Is everyone clear on this? How to discount it? And for your purposes, you would be either using a calculator, or most probably will get the present value factors. But what we need to understand is, I want to talk about one thing, guys. There are two things. One is present value of annuity when there are same cash flows. In that case, you can use a present value annuity factor. There could be a scenario when you don't have same cash flows. So you will get a present value of single amount every year, not annuity. Everyone okay with that? We need to understand, what present value factors we need to know. We need to save the time after all, right? So let us also understand our deciding criteria. That's okay. NPV is present value of all the cash inflows minus initial investment. That's absolutely correct. We know the life of the project and everything, but we also know the decision rule here. Decision is, if my NPV is more than 0, we accept the project. If NPV is less than 0, we reject the project. As simple as it is. And if there are multiple projects and that allows us, the funding allows us to enter into more than one project, we will go for that combination that will give us highest NPV. But what are the steps to calculate NPV? Let's try to understand that one by one. Some of the steps you already know, guys. When we talk about the cash flows, relevant cash flows, some of the steps you already know. First step is determining the net cash inflow in each year of investment. Didn't we do that? Didn't we already discuss that, guys? Remember my factors of depreciation tax sheet. Ignore non-cash. Not only that, interest or dividend will be excluded. Guys, that's okay. All these factors I explained you in the earlier slide. We have to calculate the net cash inflow in each year of the investment. We already discussed the first point. Second point is select the rate of return or discounting rate for the calculating the present value, which is generally the weighted average cost of capital. That's fine. And then we are multiplying this with the relevant discounting factor for each year based on the rate of return selected. That is 1 upon 1 plus par, 1 plus r, or 1 plus k to the power n. And then we kind of add them. Once we calculate the present value, we add the present value of all the cash flows, total the amounts of all present value of the cash flows. That will give you the present value of cash inflows, guys. And then we reduce. The last step is we subtract the initial investment. So let's do one thing. Let's take an example here at the bottom of our screen. Siddharth says, what if NPV 0? Good question. Siddharth, NPV 0, then you would be indifferent towards the project, right? Either you will compare, are there better projects available? Or if, let's say, other projects are into loss and that project could give you a strategic importance, you may take that project. It's an indifferent decision point. You may or you may not. Okay. So we take that illustration at the bottom, guys. So compute NPV of a project with a net investment of rupees 1,20,000 and net cash flows for the 3 years are given 80,000, 70,000, 20,000 respectively. And they have given you the present value factors 10 year as per the 10%, 0.90, 0.826 and 0.75. So you have to provide recommendation, guys. What is initial investment here? 120. So that is, do we need to discount the initial investment? If it's a beginning of the year, you don't need, right? So that's the present value factor is 1. It's the beginning of the year. But if there is an additional investment later on, let's say at the end of the year, at the end of the 2 years, then you will have to discount them also. In this example, that's not the case. So we are discounting the cash flows for all the 3 years. And when we calculate the present value of cash inflows, and we subtract the present value of cash outflow or initial investment, we are getting a NPV of a positive 25,560. I think It's a simple decision for us. We accept the project. We accept the project. Okay. Advantages for this, of course, finally, we had a time value of money. Second, we talk about the relevant cash flows, incremental. Third, we talk about the entire life of the project is considered as opposed to the payback period. We are talking about the profitability also. These are advantages. Disadvantage, I would say that, okay, you could say that this involves some calculations. Accuracy may not be 100%, because we are estimating the future cash flows and so on, right? Even the discounting rate. That's fine. Based on the best available information, we are still doing our job. That's it. And that's the beauty of the NPV method. But we will be discussing at some point, either today or on Tuesday, a comparison where a net present value method and IRR may clash. We'll talk about that later on. Okay. Let's have a look at a couple of brain teasers, guys. You have question number 1 and question number 2 on your screens. While you give your answers, please mention the question number also. I'm waiting for your answers, guys. Question number 1 and question number 2 on your screens. Okay, so I can see majority of you are giving me question number 1 answer as D. A capital budgeting technique which does not require the computation of cost of capital. Is we're talking about like for discounting purposes or decision making purposes, whatever, but which does not require computation of cost of capital. Can we say this is basically nothing but non-discounting technique? This question is asking us which is a non-discounting technique. That's it. NPV is. IRR we are yet to discuss, definitely is, and MIRR is another method we'll be talking about on Tuesday most probably. So definitely the payback method is one, guys. We discussed today. Payback method is not taking into account the time value of money. So that's definitely the correct answer. Now I can also see lot many students have already given me the answer for question number 2, which says answer as A, I guess. Like majority of your sentence also mentioned as B. I can see a couple of answers as option number B also. In case of a company considering a discounting factor higher than cost of capital for arriving at present value. First of all, let me stop here. Let me stop here for a moment. Guys, if I am considering a discounting factor higher than cost of capital, higher, that means I am multiplying with a higher rate of return, guys. And do you agree? In that case, if this is a mathematical question, if I am dividing by a larger number, my present value will reduce. My present value will reduce. Does this sound logical to you guys? I am discounting by a larger rate. Do you think it's a mathematical question? Let's say, if I say, let's say 8 upon 10 is a 0.8, but if I say 8 upon 12 is a 0.67. It's as simple as that. So that means if I'm discounting something by a larger number, that has to be less, right? And if I look at the options, option B and C are talking about more than computed based on the cost of capital. So guys, let's assume, let me take an example here. Let's say my cost of capital is 6%, whereas you are using the hurdle rate as 8%. So you are discounting as 1.108 as compared to 1.106. I'm sure 1.108 will be giving you lesser cash flows. Guys, everyone with me on this? Those of you who gave me option number B, are you clear that we are talking about option number A only? Because we are dividing it by a larger number. Guys, all okay? Yeah, great. Now let's do one thing. Let's quickly have a look at another practical question here, guys. Right? Or what we can do is 7:15 right now. I'm just looking at the time. Uh, could be better that if you want a quick break here, then we come back with a fresh mind and then we target this question, guys. We attack this question after a break. So let's do this. Let's take a good break here. Let's be back in 5 minutes, guys. I hope quick break would be good enough. Let's target to have come back, guys. Have your tea, coffee, water, whatever. Come back in 5 minutes and then we will resume, guys. Take a break. So, friends, welcome back. I hope all of you are back after a much needed break here. Quick catch up, always good while we are into the groove of some serious discussions happening here. So, we are on the verge of a lot of practice, guys. We are talking about NPV, we'll be moving towards other discounting techniques also. But before we do that, let's look at this MTR limited question on your screen. Okay. So MTR limited here is considering buying a new machine. I want everyone to concentrate here, which would have a useful economic life of 5 years at a cost of 25 lakhs, scrap value of 3 lakhs with 80% of the cost being payable at the beginning of the project. Now that could be a very interesting point. Entire 25 lakh is not initial investment here. 80% of the cost being payable at the start and 20% at the end of the first year. Now, the machine would produce 75,000 units per annum of a new product with the estimated selling price of 300. Direct cost 285 per unit, and annual fixed cost, including depreciation, calculated on a straight line basis, is 8,40,000 per annum. In the first year and the second year, there is special sales promotion expenditure not included in the above cost. So I think the key word is not included. So I'm sure you have to take care of that. And then we are required to calculate NPV, and the cost of capital is given to us as 14%, folks. So we're talking about a 14% situation in this case. Now, how do we go about it, guys? What do you think? What should be the first step? Can anyone tell me what should be the first step here? What should be our first step, guys? First step should be identifying the cash flows. Am I correct? Wouldn't it make sense to identify the cash flows? And we know there are initial outflow and there is one outflow after the end of the 1 year. And then what we also need to calculate is my cash inflows for every year. And then, yes, there are a couple of sales promotion expenses also given to us. That's definitely the requirement, right? So, absolutely. So I can see Smitha, I can see Srinivas, you guys are definitely on the spot. So we need to calculate the cash flows, guys. May I have a question here to all of you? Like, okay, year 0 may we have a 20 lakhs cash outflow. Year 1 may we have a 5 lakh, right? So let's put it here. As per the question, we have a 20 lakhs here. We have a 5 lakhs here. And then they've given us the first year and the second year. There is a sales promotion of 1 lakh and 1.5. What I'm more interested is calculating is my cash flows in terms of, okay, what is my selling price? What is my cost? How will you calculate that? My selling price is 300. My selling price is 300, guys. So, and the variable cost or direct cost given to us, 285. That is 15 per unit. And we are talking about 75,000 units here. Is everyone with me on this? All with me, guys? What will be the total contribution in that case? If my variable costs are 285, that means my contribution in this case will be 15 into 75,000. Probably that is 11 lakh 25 if I'm not wrong. 11 lakh 25,000 is my contribution, guys. All with me. And this is annual stuff. We're talking about annual stuff here. And then we also need to know that there is a fixed cost given to us. If I reduce the fixed cost of 8,40,000, there could be a problem because that includes depreciation. So let's calculate depreciation first, guys. What is the depreciation here? What is the depreciation? Scrap value of 3 lakhs. So 25 lakhs minus 3 lakhs. So we are looking at 22 divided by 5 years. Can we say depreciation is 4,40,000? And hence fixed cost is 8,40,000 excluding depreciation, because again we are talking about a non-cash, and lucky we that we are ignoring the tax for this illustration, so no tax calculation is required. So the fixed cost excluding the depreciation is 840 minus 440. This happens to be a 400,000. Guys, everyone with me? Can everyone understand how did we calculate the cash flows of 7,25,000? Yes or no? Is everyone with me on this? Let me just check your responses. I want a comfort level for everyone that yearly cash flows is 7,25,000. Okay, I've got a couple of confirmations. What about others, guys? Hitesh, Bandredi, and I think a couple of more students are telling me that it's fine. But if you have any doubts, let me know. Smitha, also Sudhanshu, Gihani, and okay, great. So I think it's glad that you guys are working around this with me. You guys have to solve this. You have to be ready with your infrastructure in terms of pen and paper, right? So let's plot this into our table, guys. So we know that in the year 0, we are talking about an year 1, we are talking about a 20 lakhs and 5 lakhs. And then we have a sales promotion of 1 and 150. And 7,25,000 is what we calculated, right? Year 1, year 2, year 3, year 4, year 5. However, there is a terminal year cash flow of 3 lakh, which is a scrap value. So the total cash flows for all the years, including year 0, is given to us now. We have computed, not given rather. Minus 20 lakhs in the year 0, that is today. Initial outflow is 20 lakhs. And then we have 1,25,000, 575, 725, and so on. What we need to calculate is now multiply this by the present value factors at the rate of 14%. So present value factors at the rate of 14%, 1 divided by 1.14, 0.7695, and so on. 99% you'll be getting these factors or the table in case you don't have. I hope everyone understand, and we discussed this earlier, how to calculate this using a simple calculator, right? So we talk about 1.1 divided by 1.14 is giving us 0.8772. And if I'm saying that, okay, 0.8772, I have to just press one more equal to, I will get the second year. Another equal to, I'll get the third year, guys. But we could not use present value of annuity factor here because the cash flows were not uniform, right? If the cash flows were uniform, we could have used annuity factor also. Like, let's say one annuity factor multiplied by that uniform cash flows. But we do not have that flexibility with us. So we multiply all the year's cash flows with their respective discounting factors, and then we add them. And once we add all the present value of cash inflows here, and we reduce the initial 20 lakhs, we get a positive 3,058. Hiral says, Hiral question is why 25 is divided between 20 and 5. Hiral, can you see the second line of the question, please? Hiral, 25 lakhs and a scrap value 3 lakhs with 80% of the cost being payable at the start and 20% at the end of the first year. Hiral, that was given in the question itself. Someone asking me what happens if the tax is given in this question. You will adjust the tax, right? We'll take after tax. Don't worry, we will have those questions as well. If tax is given in the question, guys, tax impact will be taken on the cash flows. That's it. Guys, everyone okay? Since NPV is more than 0, we'll accept this project, guys. I hope everyone is with me. Just want to check everyone, is all of you are comfortable in this point? Getting your calculations. If you're getting some rounding of differences here and there, that's fine, guys. Don't worry about them. Okay, great. Now, let's talk about a few other discounting techniques, guys. Another discounted technique we're talking about is a profitability index. Now, when we say profitability, NPV, guys, NPV was what? Present value of cash inflows minus present value of cash outflows. When we use profitability index, also called as a present value index or desirability factor, we divide them. We divide present value of cash inflows upon present value of cash outflows or initial investment. Now, in this case, this is helpful in terms of that because the NPV is giving us absolute number, right? This is actually helping us to compare the projects which involve different amounts of cash inflows. So the decision is very simple. If profitability index is more than 1, my numerator is greater than denominator, right? My present value of cash inflows is more than more than my present value of cash outflows, then profitability index has to be more than 1. So you accept when it is more than 1, and if it is less than 1, reject. However, if there are mutually exclusive projects, a project with a higher profitability index be selected. Sudhanshu has a point in the last question. Sudhanshu says, why depreciation is not reduced from contribution? It is also fixed cost. Sudhanshu, do you agree with me that initial 25 lakhs you have already considered as cash outflow? Yes or no? Initial 25, like 20 lakhs and 5 lakhs. And the depreciation is on the same only. So that becomes non-cash in the later years. So depreciation is not a cash outflow in the later years. Now. That was related to the initial outflow itself. We have already taken outflow of 20 lakhs and 5 lakhs. So Dhanshu, I hope it is clear. We ignore depreciation because it is non-cash. It is not a cash expenditure. Yeah. Okay, guys. So coming back to the example on the profitability index. Let's look at the example. Now, two projects with a discounted cash outflow is 1 lakh and 1,20,000. Discounted cash inflow is 150 and 190. So profitability index for the project 1 is 1.5, project 2 is 1.58, and hence the second project should be preferred. Now, why I am saying that it could be slightly better than NPV? Because that is giving us absolute measure, whereas a profitability index is giving us a relative measure. However, it may help us in rejecting a lower profitability index. But the problem only is, okay, let me give you an example here. So a present value of inflows and present value of outflows. Okay, so guys, I'm giving you an example here. Two projects. You can see present value of inflow and outflow here. What is the profitability index for project A? 1.25. What is the profitability index for project B? 1.20. On this basis, you will be selecting project A. But if I calculate NPV, which is an absolute number, project A is giving me only 2,000, whereas project B is giving me 10,000. So the point is, in this case, we need to understand that sometimes, in an organization where we talk about, like, Raghavan said, mutually exclusive project and so on, where we are more also concerned about the profitability. This particular method can ignore project B, right? Whereas in the absolute terms, there was a higher profitability. Guys, does it make sense? So the idea is that we may reject a lower profitability index, but they can give you a higher absolute returns, right? I hope that example clarifies the disadvantage, right, of profitability index. Okay, now let's move to Another question as a matter of practice, guys. Let's have a look at this. This question talks about of Navjeevani Hospital is considering to purchase a machine for medical projectional radiography, which is priced at 2 lakhs. Projected life of the machine is 8 years and has an expected salvage value of 18,000. At the end of the 8th year, annual operating cost of machine is 22,500. It's expected to generate a 1,20,000 per year for 8 years. Presently, the hospital is outsourced to a radiography work to its neighbor, and it's earning a commission income, wow, of 36,000 per annum. And we need to calculate whether it would be profitable for the hospital to purchase the machine. And we have to give our recommendations using both the methods. Now, before I start working on this question, can anyone tell me, if we want to purchase the machine, will there be any opportunity cost involved, guys? That is my first question to everyone. Will there be any opportunity cost? Who will tell? Opportunity cost, everyone understand that? So Smita says, yes, there is an opportunity cost. I think, yes, there is an opportunity cost, right? So 36,000 commission. Sudhanshu, we are already earning a 36,000 commission by outsourcing that. So you will be losing that, right? If you want to do your own manufacturing by purchasing a machinery. So that 36,000 would be definitely a opportunity cost, right? So now let's try to understand. If we want to proceed with this particular question, we need to calculate the cash flows, guys. We need to calculate the cash flows. Can anyone tell me how do we calculate the cash flows? Or what exactly we need? We need some numbers here, right? So let's say we are talking about sales of 1,20,000. We are talking about the operating cost of 22,500. Anything else we need apart from these two? I think we also need to calculate depreciation. Am I correct? You need to calculate the depreciation. Depreciation is calculate at 2 lakhs minus 18,000, right? Divide by 8. So are you getting a depreciation of a 22,750, guys? 2 lakhs minus 18,000 divided by 8. Depreciation is 22,750. So that means we are getting a 74,750 profit before tax. Anything else we are missing here? Anything else we are missing here? Okay, great. I can see a lot of students are responding already. Great. And we are talking about tax. I think tax is also given to us, right? So tax is 30%. So if we calculate the tax part, we are talking about 22,425. 74,750 minus 22,425 is giving us annual earnings of 52,325. But my point is, are we taking 52,325? Probably we also need to understand that in this 52,325, we need to add back the depreciation, guys. We need to add back the depreciation that we reduced 22,500. So 74,825. And not only that, we also need to reduce the opportunity cost. What is the opportunity cost? And mind you, will you adjust the opportunity, the tax on the opportunity cost, guys? Will you adjust the tax on the opportunity cost? That's already given to you. It's already given to you net of tax. Okay. So I think someone said that a calculation error. So let's correct that. So depreciation added back is not 22,500 but 22,750. Okay. So your amount comes out to be a 75,075. Is it okay, guys? Now, so someone pointed out that it should be 75,075. Gyani, I've corrected that. Thanks for noting. Okay, what about the opportunity cost, guys? This is already net of tax. So don't need to adjust, right? So we have to just adjust the opportunity cost, 36,000. So you're getting 39,075. That opportunity cost is also cost, right? That is already given to us net of tax. So that means every year there will be 39,075, guys. Do you agree with me? Every year there will be a 39,075 cash inflows. However, in the last year, there will be 18,000 expected salvage value as well. In the last year, there will be 39,000 plus 18,000, guys. Salvage value is also there last year. Right? So, and they've given you the present value factors for 8 years here. So let's look at our calculations. What we did was, we had just calculated a 39,075 already. And everyone with me on this. But for the 8 year, there is additional 18,000 coming into the picture. So in this case, what I was talking about, since in year 1 to 7, there is an annuity clear cut. We can just add all the factors given to us for the 7 years, and we can just multiply just 1, 4.867. This is present value annuity factor, right? Which is adding up all the present values of this 0.909 plus 0.2, 0.826 plus this and this, right? So this is a present value annuity factor. And then for 8th year, we are using a single amount of 0.467, which is giving us 2,16,832. And my cash outflow is 2 lakhs, and hence NPV is 16,832. Now, Hiral says, why we added back depreciation? Hiral, is depreciation cash or non-cash? I think we discussed this a couple of times, right? Is depreciation cash or non-cash? It's a non-cash, right? Because you anyways are recording the aspect with respect to the revenue and operating costs. So we are only considering the cash profits, not the non-cash items. Hiral, is it making sense now? The depreciation will be calculated based on the initial cash outflows only. So 2 lakhs is anyways considered for calculating the depreciation. Guys, anyone else is still finding why we are adding back depreciation? Because we are talking about cash profits after tax. So we have to eliminate the non-cash items. Hiral, everyone else, all okay, guys? Would be great if you guys can confirm. Now, I have a question here. If NPV is positive, very natural that profitability index is also more than 1, right? This is very logical, right? If NPV is positive, that means my present value of inflow is more. And we just divide for present value index. So accordingly, my present value index has to be more than 1, and hence the project can be accepted. The machine can be purchased. So I hope everyone understood the calculation part and the logics behind this. Now, as we say that, we move on to the next important method here. Okay, that is internal rate of return. Now, very important. It's like now we are on the other side of the table. We have to understand that, okay, what is the discounting rate? What is the discounting rate at which the present value of the expected cash inflows equal to the present value of the cash outflows? Can we say this is a rate where NPV is 0, guys? Am I correct? Am I correct? This is a rate where the NPV is 0. But I have a question to all of you. Please listen to my question carefully and then reply yes or no. When I'm calculating IRR, is it the actual return on the project? Please tell me yes or no. Is it the actual return on the project? Yes or no? Let's see your responses. Srinivas says yes. Okay. What about others? Raghavan says no. Smita says yes. Amazing. I think I'm getting some kind of interesting, spicy answers here now. The second half of our lectures are generally amazing, right? Pandredi says no. Guys, what is the definition of IRR? IRR is that rate at which the present value of the expected cash inflows equals the present cash outflows. Does this mean that it is the return on a project? No. We are just calculating a mathematical number at what rate, if we discount, the NPV becomes zero. It is not giving you the actual return on the project, please. So answer is no, right? Guys, everyone okay, please? It cannot be the actual return. Let me give you a perspective here. Okay, please be with me. Okay, let's talk about our perspective. Let's say a particular project has been undertaken by a company. Let's say a project has been undertaken by company A, and company A has a WACC, weighted average cost of capital, or their hurdle rate, let's say 10%. Now, there is a situation. In this situation, let us say that the project is giving us an IRR of 8%. This is scenario A, guys. Project is giving us IRR of 8%. What do you think? At 10%, what will be the NPV? Positive or negative? Tell me, guys. NPV at 10% will be positive or negative? Don't worry, guys. I'm getting query for the practical question we will be discussing. So Tripurari, we will be talking about practical questions. I'm just explaining a concept right now. Okay, now can you guys tell me what if the NPV at 10% will be positive or negative here? I'm again repeating a question. There is a project but taken by a company. The company's hurdle rate or WCC is 10%, and we calculated project IRR at 8%. Let's say it is given to you. 8% is the rate where the project is having an NPV of 0. What I am asking you is, if I have to calculate NPV at 10%, will that be a positive or negative? Gihani says negative, Sudhanshu says negative, but Bhardwaj says positive. Okay, what about others? Anyone else want to talk about? Anyone else want to give a perspective? Okay, so that means if I'm saying IRR, Raghavan says negative, Hiral says positive. Okay, let me kind of break the ice. If I'm saying IRR is 8%, that means NPV at the rate of 8% is 0, guys. So instead of multiplying something by 1 upon 1.08, now I'm actually multiplying this by 1.1.0. So I'm dividing with a larger number, NPV should go down, guys. And hence it should be negative. Are you getting it, guys? It has to be negative. See, if discounting at 8% giving you 0, right? You discount at a larger rate, it will be a negative number, na? Because in discounting, you are dividing it 1 upon 1 plus K, 1 upon 1 plus R, whatever. Guys, are you understanding it? This is a mathematical gyan. It has to be negative. Although it's good to be positive in life, but the answer is negative here. Is everyone okay? I want a confirmation. I can give you another example. Let's say the IRR is actually a 13% for the same project. What will be the NPV at 10%? Will it be a positive or negative now? IRR is 13%. NPV at 10%, guys. Will it be positive or negative? Now tell me. I have twisted the table now. I'm sure now I will be getting uniform answers. I hope that after explaining this. Now everyone is rocketly, solidly telling me it's positive. Okay, give me a second. I'm checking the responses also. So I think most of you are giving me a solid answer that it will be a positive. I'm just looking if anyone said negative. Okay, I think I got more than 10 answers, guys, all positive. That's amazing, because in this case, you guys got it at NPV at 13% is 0. And when I'm discounting with a lower number, it has to be positive. Can we conclude something on this? Can we conclude something basis on this? That means if IRR of a project is less than the hurdle rate of the company, we should not accept the project. Do you agree with me? If IRR of the company is more than the hurdle rate of the company or the WACC, then you should accept the project. So if IRR is less than my hurdle rate, don't accept it. If it is more, I should accept it. Because I can conclude this. Because at the hurdle rate, my NPV can be positive or negatively accordingly. And that is what we are talking about here in the second bullet point. You compare the organization's hurdle rate with the IRR. So let us calculate IRR also. Let us do some calculation for IRR. Now, first case is where we have a uniform cash flows. Now, if I'm talking about uniform cash flows, means same every year. And we are talking about at IRR, the present value of cash inflow is equal to present value of cash outflow or initial investment. So can we say if it is a uniform outflow or a uniform inflow every year, we can use a present value annuity factor multiplied by annual cash inflow is giving me a present value of cash outflow, guys. So basically, this will just let us help to calculate the annuity factor straight away. So that means, let's take an example here. Let's take an example. Let's say there is a project with an outflow of 1 lakh. And 5 years, or rather 4 years is the project life. And I'm saying that my inflow is 25,000 every year. So it's a uniform case. After tax inflows is given to us 25. So in this case, what I will do is I have to discount this 25,000. I generally do this, right? 1 plus R, 25,000 into 1 plus R square and so on. And we go on for the 4th year, guys. Generally, I do that. Instead, what do we do is now we take 25,000 outside and we do this 1 plus R square and we take it to 1 plus R to the power 4. This bracket section is called as present value annuity factor. So present value annuity factor multiplied by 25,000 will be 1 lakhs because at IRR, your outflow is equal to the present value of the inflow. So that means I get present value annuity factor as 4 here. I get present value annuity factor as 4. That means how I will be looking at on this one is, give me a second. Let me show you this as well. What we'll have to see is that whether we can look at an annuity table, let's say. Let me share you some example with you. Let's say if on my screen, if you see an annuity table, right? So right now, we are looking, look at the heading of this table, guys. Cumulative present value factors. Cumulative means annuity, right? Cumulative means annuity on the top. Now, that means we have to look for 4th year, right? This is the 4-year project, guys. Can you see on the left? We are looking at the 4-year project here. This particular row, are we seeing somewhere something closer to 4 here, present value annuity factor? I think probably we are looking at very less amount. Guys, what do you think? Can anyone tell me which particular rate it seems to be? Which particular rate it seems to be? Who will tell this? Let me see your answers. What do you think? See, of course, if I go higher and higher, that means it will not be, it will be further lesser number. Probably this case, even at a 1%, the discounting seems to be 3.9, right? In this case, even the discounting at 1% is giving me 3.9. So probably it's a very negligible rate in this case, right? So if we are looking at an annuity table in this case. So let us go back to our example. Let us say that if you want to twist it at some number, because we are looking at 25,000 and the same number is coming in, right? So can we do something else? Let's say we make it 30,000, let's say. Can we do that, guys? So let's say it is a 30,000. So Smita says it's the same number and we are probably just, hardly getting any return. So we change this 25,000 to a 30,000. So that I can explain you how to use annuity table in that case. And if I say 30,000, what will be my present value annuity factor, guys? Can anyone tell me? If I change 25,000 to a 30,000 number, in that case, my present value annuity factor becomes 3.33. Is everyone with me on this? Guys, I hope you are understanding, right? We are discussing the uniform cash flows. Uniform. In that case, we just multiply one factor to a particular uniform cash flows. But we have to calculate now that present value annuity factor is 3.33, but we don't know the rate right now. We don't know the rate right now. We have to calculate the rate. Now, if I take you guys from this to the annuity table once again, 3.33. Can we see something which is roughly around 3.33 for on this annuity table? Okay, I can see that my rate seems to be somewhere between 7 and 8%. Do you agree with me? My rate is somewhere between 7 and 8%. That's where the 3.33 falls. And probably it is little closer to 8 than 7. Guys, can you see that? I can zoom it for you guys. The number which I have put in the rectangle between 7 and 8. Everyone okay, I suppose. So For a uniform cash flows, it would be great that we could have got the directly a particular rate against which that present value annuity factor number is given, but it is not the case always. So let us try to use a formula here. Let us try to use a formula. What I'm trying to say is that when we have uniform cash flows, IRR shall be that rate that corresponds to the annuity factor in the annuity table along with the row for number of periods. So we talk about the 4 years, right? We talk about the 4 years. But if in case it doesn't match, in our case, it falls between two rates for the period, then in our case, guys, we said that, okay, it is between 7% and 8%. Now we have to calculate NPV at both the numbers, NPV at 7% and NPV at 8%, guys. We have to calculate the NPV of this project at 7% and 8% and apply this formula. And you need to remember this formula, guys. IRR formula, lower rate plus NPV at lower rate upon the difference between NPV at lower minus NPV at higher rate multiplied by the rate differential. The question I need to ask is, can anyone think in this case, will NPV at 8% be negative and NPV at 7% be positive? Can I say that? Because at a lower number, NPV will be higher. At a higher number, NPV will be lesser. Generally, for this formula, we need one positive NPV and one negative NPV. Right? Uniform cash flows, at least we came around something, right? We came around 7 to 8%. That was a big help for us. Then we are using this formula. But what if we did not have uniform cash flows altogether? Do you think we will be in some kind of a trouble? If we do not have uniform cash flows, then of course we anyways have to assume two random rates, because we don't even know the rates over there. So first of all, I want to confirm with you guys, do you guys find yourself comfortable when it comes to the uniform cash flows and we are calculating the NPV? You can quickly calculate the present value annuity factor and look at the corresponding table. If it matches exactly, you got the rate. If it doesn't match, you have to calculate the NPVs at two rates and apply this formula. Is everyone okay here? Right? So let's see this example here to make this understanding more robust. Zebra Limited is evaluating a project with a capital outlay of a 10 lakhs, resulting in an annual cash inflow for 2,50,000 for each of the 6 years. And the scrap is 0. So guys, is it a case of a uniform cash inflows? I guess yes. So we are looking at 10 lakhs uniform or cash inflows of 25,000 for 6 years. So when we divide this, we get the annuity factor as 4, same as my example. The only difference is that we have to now look for the table against the period for 6 years, guys. You have to look at the 6 years. Can you see 4 lies between the two, 12% and 13%, guys, this time around? This time we are looking at a difference of 12 to 13%. But we can very well imagine that this rate is very much closer to 13% by the naked eye. Do you agree with me? Because the number 4 is very closer to 3.9998. So rate would be closer to 13%, but we cannot conclude that. We have to calculate that, right? So basically, once we know that my IRR has to be between 12 and 13, I need to calculate the NPV, right? So we know the rates here on the screen. It's very easy to calculate, right? We multiply 2,50,000. We calculate the NPV at 12%. We get positive number. And look at that NPV at 13%. Didn't I tell you? NPV at 13% has to be negative. So because that in that present value factor is lesser than 4, right? So here you can see we calculated the NPV at 12% and 13%. And once we applied that formula, we are getting IRR of 12.98%. Now that doesn't surprise me. Does this surprise to anyone? That doesn't surprise me. We anticipated that IRR will be closer to 13% in this case. because my annuity factor was 4. And for 13%, it was 3.998. Guys, everyone with me on this? Any doubts, please let me know. Are everyone finding yourself comfortable at this point? So this illustration on the screen is clear, guys? Yes or no? Any questions, please let me know. I'm constantly checking the query panel. I can see Hitesh, Bandreddi, Smita, Sudhanshu. Everyone confirmed all okay. Great, guys. Thanks a lot. Okay, great. Now, the problem here is uneven cash flows. Now, in this case, of course, you do not find random, you do not find rates, right? That you have to calculate NPV at this rate and that rate. It's uneven cash flows. How can you divide initial investment by uneven cash flows? You cannot just add them and divide, right? You cannot take an average cash flows. It's not even, right? It's uneven. In this case, you have to start calculating NPV with any random rate. Take 10% or 15%, 12%, 8%, whatever you like. However, you have to calculate NPV at 2 rates, guys. So let's say you select any rate as a random rate as a first rate. If NPV at the first rate is positive, if NPV at a first rate is positive, your second rate has to be higher than first one, because you have to understand that for that formula to work, we have to get 2 NPVs, one positive and another one we need negative. We need 2 NPVs. So that means if we select any random rate and my NPV comes out negative, guys, NPV comes out negative. In that case, second rate will also be random. So let's say you calculate NPV at 10%, it is negative. So I would say that, okay, go for 6% then. Second rate will be a lower one because you need a positive NPV now. Guys, is this clear to everyone? So first random rate and its NPV will decide whether second rate should be higher or lower. Am I making this clear? So first NPV rate will decide, guys. If it is positive NPV, I need second one as a negative. So I need to take discounting at a higher rate, mathematical gyan. Again, I'm giving you mathematical gyan. We divide by a higher number. And if the first random rate is giving me a negative NPV, I have to lower my second rate so that I get a positive NPV. And also, we need to understand that since I'm looking at this formula as you can see the formula here, we're looking at a lower rate plus NPV at lower rate upon NPV at lower rate minus NPV at higher rate, this fraction multiplied by the rate differential. Since this is the formula, we are talking about higher rate NPV to be negative, right? So if I look at my denominator, and let's say NPV at lower rate is A, and NPV at higher rate has to be minus B, and there is a minus sign, do we agree that it will minus will cancel out? It will be an addition eventually, because I need a negative and a positive NPV, and NPV at higher rate will be -1. Sudhanshu is practicing a question. He get a positive NP at 5%, it also positive 8%. Okay, Sudhanshu, it depends on how much positive. Let's say at 5%, if I'm getting the positive number of 30,000 rupees, I would definitely reconsider my 5%, right? I will take my second rate as 15% then. But if I'm getting, let's say, positive number of 5,000, then probably next number could be 8%, 10%. Sudhanshu, does it make sense? So of course it depends on how much positive or how much negative. Okay, guys. So all okay with the formula that in the denominator it will be more or less always an addition, because we are taking one negative NPV and we are taking one positive NPV. In the formula, in the denominator, it will be minus minus becoming plus, right? Okay, so guys, the acceptance rule with IRR, I already told you guys, if IRR is more than WACC, you accept the project, because in that case, at the hurdle rate, my NPV shall be positive. I already explained you. Because WACC is a lower rate. And if IRR is less than WACC, you should reject the project, because your NPV at the hurdle rate will be negative. So acceptance criteria is, anyways, we are referring to NPV indirectly. We are referring to NPV indirectly here. This is what I explained to you for a decision criteria. Absolutely. Hiral has a point. Hiral, good job. Hiral says that that I anyways briefed that in the YTM method for cost of capital for debt. I hope that rings some alarm bells in each one of you. That is what we discussed earlier, later last month, right? In the cost of capital section. This is the same formula we discussed, guys. Can we, move to a little bit of a practice question, guys? Okay, so let me just kind of give you a quick practice question here. Everyone can see the illustration here, guys. Quick illustration on the screen. So company proposes to install machine involving a capital cost of 3,60,000. The life of machine is 5 years and its salvage value at the end of the life is nil. The machine will produce net operating income after depreciation of 68,000, and the company's tax rate is 45%. Tax rate is huge actually. Okay. Net present value factors are given for 14, 15, 16, 17, and they are given cumulative factors. Interesting. Why cumulative factors? Because we have uniform inflows, right? Uniform, right? Great. Now, we have to calculate my annual cash inflows. We are looking at net operating income after depreciation, guys. But we need to have post-tax excluding depreciation. So my first step is to calculate profit after tax. From 68,000, I reduce my tax. I will get profit after tax here. And then I will add back the depreciation of 72,000. How come 72,000, guys? 3,60,000 divided by 5, there is no salvage value. So 70,000 is added back. So I'm getting cash inflows of 1,09,400. Okay, so I have a question. Let me just quickly read out. Prabhas says how to determine the first rate, because on the one sum I took lower at 10% and then NP was so high I had to go 25%. Prabhas, again, I would definitely recommend to keep the margin as low. In case probably your 10% was so high, why don't you think of selecting your first rate itself as a 15%, right? Yes, this is a good point by Prabhas, because it's more of a hit and trial method. The larger the gap, your answer may not be as accurate. Prabhas, I hope you understand my point. If it is too much of a variation, I would definitely go for two different rates, which gives me a lesser scope. Like the gap should not be more than 5%, I guess, at max. Hiral, thanks for the confirmation, for the clarity. Okay, Prabhas, I hope that makes sense, the point I made. And don't worry, Prabhas, if there is a marginal difference because of the different rates taken by you and the study material, don't even worry about that. You would be giving your assumptions, you would be taking your rates. So if there is no error in that, no one is going to penalize you, right? But yes, on a safer side, keep the difference as less as possible. Okay, so Raghavan is challenging the question. Raghavan says, how the hell the tax rate is 45% when in income tax we studied maximum 30%? I like that. I think the best query of the day, right? Guys, do you all agree? So Raghavan says, how the hell the tax rate can be more than 30%? So Raghavan, we are on a different planet. We are on the planet capital vesting today. A very good question. Okay. So we don't challenge the question, right? We just take the information given here. So guys, everyone agreeing with the 1,09,400 here? All are with me on this? 1,09,400. And since it is a case of uniform cash flows, we just need to divide 3,60,000 by 1,09,400. That's what we need to divide, guys. So when we divide 3,60,000 divided by 1,09,400, we're getting 3.29. And when I'm taking these factors for 5 years from my present value table, I get this on your screen, guys. When I'm looking at present value tables, I can see that 3.29 is actually falling between 15 and 16%, but by naked eye, I can see that it is very closer to 16 actually. So my answer probably is more than 15.5. That's what I'm thinking. Prabhas, I think that is also a good way to look at, right? To your question, I think this is also a good way, like which rate it is closer to. So in this case, like I can calculate a midpoint and I can estimate, okay, my rate will be the second half. So in this case, it is like 15 and 16, so it has to be more than 15.5. So then we calculate the present value using this cumulative factor, right? So present value of inflows using 3.35 and 3.27. And we calculate NPV at 15% is a positive, at 16% is negative. Guys, do you see that in the denominator that becomes a plus because it was minus 2262? Do you see that in the denominator it gets a plus because it was minus? I think it's a good income tax competition. Pooja comes up with another rate of 40% for foreign companies. Okay, I'm sure you guys are all excited about your income tax, I believe, right? And good to know that you guys know your rates, right? Good to know that you're not forgetting other subjects when you're focusing on one. Don't worry, forget about the tax rate right now. So Prabhat, Pooja, everyone, don't worry about the tax rate. Okay, let's focus on this. So guys, everyone okay with the calculation here? 15.74 using the same formula. All of you are with me on this particular illustration. Can you please confirm? Okay, guys. So if you guys are all clear in the calculation, here it says how many marks of these questions. So here it depends on the requirement, right? It could be a 10-mark question, it could be a 6-mark question, it could be a 12-mark question. Of course, you have your past year papers to refer the marking scheme, right? It depending on the requirements of the question. Okay. So guys, everyone please focus on the brainstorming question on the particular screen right now. Should it be A, B, C, D? Let's see what are your answers. Okay, so I think everyone is like looking as a answer is mixing between D and A. Wow. What about others, guys? I'm getting like two answers right now, A and D. I think Bandreti, there is some technical glitch happened at your end. I can see lot many blank enters from your side. I think lot of blank answers. Okay, so I'm getting all the answers right now. A, B, D. Okay, let me kind of cut this short. Is the requirement of this question is what? Which of the following events would decrease the IRR of a proposed visit? Now, let's say IRR is that NPV. Is that rate where the NPV is 0? So that means we are saying that this is my inflows multiplying the 1 upon 1 plus R n whatever minus initial investment is 0. Guys, everyone with me on this? This is my IRR formula. We calculate the present value of inflows minus initial investment has to be 0, right? Now, let us start with D, guys. We are looking at using the written down value method instead of straight line method. Yes, if this is the case, depreciation will be more. If this is the case, depreciation will be more. If depreciation will be more, the tax savings will be higher. Tax shield will be higher. If tax shield will be higher, my inflows will be more. Guys, everyone with me on this? If depreciation is higher in the initial years, my tax shield is higher. Inflows are higher. Now, assuming everything is same and my inflows are increasing, initial investment, there is no change. Don't you think this will actually result in reducing the IRR? Because what we are talking about is, increasing the IRR, not reducing, increasing the IRR. Because my IRR, my NPV has to be 0, right? And if my inflows are increasing, I have to multiply it by a larger number to ensure that my NPV remains 0, because there is no other change. There is no other change, guys. So it cannot be option number D for sure. Some students told me option number D, it cannot be option number D. If I look at option number C, shorten the payback period. Again, the same logic, guys. How can the payback period be shortened? My inflows will be increased. And if my inflows will be increased, my rate has to be also increased, guys. So C cannot be the answer. Is C and D clear to everyone? C and D clear, getting clear to everyone, guys, here? Because these are resulting in increase of my IRR, not decrease, because my NPV at that rate has to be 0. Can everyone confirm? C and D are all okay? Great. Let's look at B, guys. B is saying decrease related working capital requirements. I think same logic. If I say decrease related working capital logic, we are saying that, okay, my initial, or I can say that if we are talking about decrease in working capital, instead, can we say in this case, let me use a different color pen for clarity. For option number B, we are saying that my initial investment is going down. If my initial investment goes down, that my NPV is kind of getting positive, which I don't want. Here also, for this to be 0, my inflows, there is no change. But unfortunately, I have to increase my rate. Unfortunately, I have to increase my IRR so that NPV becomes 0, because my initial working capital requirements are reduced, guys. So even B is not the answer. Even B is not the answer. That means we are only left with one option, is decreased tax credit. Now, what do you mean by decreased tax credits on asset? So if we say decreased tax credits, that means there is some kind of a grant or a subsidy which is reduced on an asset. That means asset cost will go up, guys. Do you agree with me? If the subsidy or a tax credit is reduced, do you agree that asset cost will increase? Asset cost will increase, that means initial investment is increasing, guys. So if I rewrite this formula, minus initial investment, this has to be 0. My initial investment is going up. That means I need to increase the present value of inflows. For that, I have to reduce my rate. IRR has to go down, and hence option number A is the correct answer. Yes, Pooja, we are not changing anything else. So other things are constant. I think couple of students, or in fact 3 or 4 students mentioned answer A. Hiral mentioned, I think, let me see. Some students mentioned option number A. So I'm actually glad those of you mentioned option number A here. I think Hiral said, and in fact, Bandreti, Raghavan, Hitesh. So good guys. I think those of you could crack the answer. That is very good. But I'm sure this was definitely not one of the easier MCQs. This was one definitely required some kind of a brainstorming, right? Everyone is like scratching their heads. How the hell or where the hell it came from, right? You never expected that MCQ could be so tricky. Gihani, in point A, if my tax credit goes down, that means it's like a credit. Like credit is kind of a subsidy, some kind of a relief which is given by government. If that is the case, my initial investment will go up now. My asset cost is increasing. To make my NPV 0, I have to increase my present value inflow, but I cannot increase my inflows. The only way I can increase the present value of inflows is I can reduce the IRR. Gihani, is it okay now? Option number A. Okay. So guys, just bear with me for 5-7 minutes more. We will wrap it up in 5-7 minutes. But I want to talk about a few things here before we log off for the day. Now, we all know that NPV was an absolute measure. And there could be some issues with IRR because IRR is not giving us the overall return on the project, right? IRR is not giving us that. Right? So IRR is giving just a percentage. So there are some issues with the IRR. Now, the IRR can be an issue for a mutually exclusive project. How is that possible? Because we are not taking into account the investment scale or even the inflows. We are just looking at a percentage. We are ignoring the absolute money. So that means if there is a project which comes up with a larger fund commitment but a lower IRR, can be rejected. However, that could have given an absolute NPV in a higher terms. That could be rejected. Also, what about the projects where cash flows change signs? That means there are multiple outflows. Let's say after every 3 years, there are outflows. In that case, of course, we may need to calculate multiple IRRs. That's a problem over there. So these are the issues with IRR. We will talk about that more on Tuesday though. But what is the assumption we take both in NPV and IRR methods? In NPV, mind you, we were using a hidden assumption that all the cash flows which were reinvested in the business that were at the discount rate used to calculate the NPV. And what is that discount rate, guys? WACC. If any earnings are reinvested in the business, they are actually reinvested at the WACC, which is okay. That's the expectation of the business. However, in IRR, the problem is that we are looking at that, okay, earnings are reinvested at the project's IRR. This is not so good. IRR is that NPV where the project is having IRR is that rate where the project is having a 0 NPV. If we are assuming that reinvestment at that rate, that means we are again favoring. So in nutshell, IRR is only favoring those projects which are heavy inflow in earlier years. What about the projects? If let's say there is a project which is very slow to start, but it is absolutely profitable in a later year, can be overlooked by IRR. That's a problem with IRR here. So let me show you the couple of advantages and disadvantages with that respect. Advantage again, IRR is talking about time value. We are considering the wealth maximization. That's okay because we are comparing with WACC, mind you. That's the only positive point. But in terms of disadvantage, I guess all of you agree with me that yes, IRR is involving complex calculation, strange reinvestment assumption. It may not be accurate number, like Prabhas said that you're getting a same number over there, and then of course it's kind of favoring those projects which have a higher inflows in the earlier years. That these are the disadvantage. Okay, now one more thing I would like to talk about here is, guys, before we end up. So this is the last thing I want to touch base, and the last thing is something which we have already talked about is your discounted payback method. This is the last point I want to cover for the day. I hope you can bear with me for just 5 more minutes. Let me show you something. So we have already talked about a payback method. And now we are moving to a discounted payback. As the name suggests, we will be discounting the cash flows in this time around. So let's say there is a project with initial investment of 100,000. And let's say I'm giving you the cash flows for 5 years. So these are the inflows. And intentionally, I'm not keeping it uniform. Can anyone tell me what would be the payback period normally? I'm not using discounted payback period. What we used to do is cumulative inflow. 30, 60, 90, 110, and 130, guys. So we can probably see that a cumulative, or let's say we add another year here. So we are looking at a normal payback period somewhere here in the 4th year. A normal payback period could be 3.5 years here, because 10,000 to recover. How 3.5, guys? 3 plus 10,000 upon 20,000. Normal payback period is clear to everyone? Yes or no? Normal payback. But can you tell me, will discounted payback period will be shorter or longer than a payback period? Discounted payback period, will it be shorter or longer? That you need to tell me. Quick answer, guys. Quick. You have to just give me an answer, shorter or longer. Just give me this answer. Will a discounted payback be a shorter or a longer? Everyone is talking about shorter, okay? Here, Sudhanshu, everyone is like shorter, okay? Okay, and Prabhas says, of course, longer. Prabhas says, guys, what's happening here? Prabhas is in a altogether different form today, right? Prabhas, you are in a top form today. Prabhas says, it has to be, of course, longer. Guys, let us prove that if Prabhat is right or wrong, okay? And everyone on one side and Prabhas is on the other side. In fact, Raghavan also said longer. So let's say I calculate discounted inflow. Let's assume, guys. Let's assume that I'm giving you discounted inflows from my end, okay? I hope you don't mind. You understand discounted inflows will be lesser in number? Everyone okay here? So our discounted inflows are reduced. So now calculate the cumulative discounted inflows. So we have a 28, 53, 75, 89, and 101.5. And then we get how much is that? Probably 112,000. In this case, what I can clearly see is that my payback is now falling onto the 5th year, guys. That means 4 complete years plus 11,000 remaining divided by 12,500. Whatever it is, let's say it is 4.8 something something. So guys, everyone with me that it has to be longer, guys. Why shorter? Because for a lesser cash inflows, you will take more time to recover. For lesser cash inflows, you will take more time to recover, right? So guys, those who said shorter, please think. It has to be longer, guys. Right? So I hope a discounted payback, you guys agree that it is a better version of a payback period because we consider the time value of money. And as we concluded, it will always be a longer period than a non-discounted payback because the discounted cash flows will always be a lower amount. So guys, on a Saturday evening, I'm ending this session by throwing the ball in your court. I know everyone is super busy tomorrow evening, right? Many of you have kept aside some slot tomorrow evening, 7:30 p.m. I know there are matches going on, there are distractions, but what you guys need to consider is you guys are preparing for much bigger than that in your life. Your examinations approaching nearer every day, right? I'm not frightening you guys. I'm making you realize that continue your hard work, continue your enthusiasm. You need to continue, you need to work hard. Whatever we have done today, I expect you guys to go through all of that. Do some practice, take past year questions as well. I have already uploaded a file with concepts and questions. Once we are done with the Tuesday's session, guys, the next session on 6th September, I will be uploading the entire file with the solutions as well. Don't even worry about that. But Bandredi is saying like 59 days remaining. Wow. So like people have done their accurate calculations. How many days to the exam? How many exams to the D-Day? Great. So guys, thanks a lot for joining in. As always, I really enjoy your company. I hope you guys does so. And you guys were awesome today and super reactive, super responsive. And I'm sure the best part is you guys are clarifying your queries there and then. You're not hesitating to ask that. It's the best part about learning, guys. So please continue your hard work. I will continue the capital budgeting or the investment decisions from modified internal rate of return on the next session. And we'll be doing a lot of practice also. So we'll have a lot of fun on Tuesday then, guys. Take care, all of you. Have a good night. Stay safe. Happy learning. Cheers.